Should you use your money to pay off your debt or build up your emergency fund? We're going to talk about it. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Returning to the podcast today is Maureen, parent, coming to us from Canada, Ontario, in the Ottawa region, I assume. Maureen, welcome back. How are you doing today?
Good. Thanks for having me back.
Well, we are always happy to chat with you, particularly when I have a question that does not have an obvious answer. So today we're going to discuss emergency funds versus debt, and people who are watching on the YouTube will see that I have like one tiny card with basically nothing written on it. So we are going to, and you have nothing as well. So we are going to wing it, which I think is entirely appropriate because this is a discussion we have with people all the time. So the question is, I've got some debt. Maybe it's a credit card. Maybe it's even a mortgage or a car loan or something. And obviously I want to pay down my debt, but I'm also told by all the financial gurus that you got to have an emergency fund. And I think you and I both absolutely agree that you have to have an emergency fund. There's no doubt about that. You know, we fully agree with that opinion. So and an emergency fund, I think, again, everybody understands what an emergency fund is. If I have an emergency, there's money there.
Right.
And so an emergency is, I got a flat tire. I have to buy a new tire. I have to repair my tire. Okay, well, I need to have the money to do that. Off the top of your head, what are the other things that I would obviously be using my emergency fund for?
Right. And I just say it is great to identify what your emergency is, because obviously not everyone has a car and not everyone has a dog. But if your dog got sick and had to go to the vet, that's also unplanned emergency. So an emergency is something that's unplanned, unforeseen, that impacts your life, basically.
And if you get a flat tire with your dog in the car, then you've hit like both of them, I guess. So I think right. You're absolutely right. It's unplanned and unforeseen. Now, I would say nothing is unforeseen. I know that I'm going to get a flat tire at some point, but certainly the timing is unforeseen. I don't know when it's going to happen, and I don't know how much it's going to be. So I have to have some money set aside. So, okay, it seems like a simple enough question. So I am of the opinion that debt is more important than an emergency fund. So, however, I'm going to have you argue the other side of it so that I can, pick on you. Give me,
I love that.
There you go. Give me off the top of your head a reason why I'm wrong. And really the emergency fund is something you should prioritize before paying down debt.
Well, if you don't have an emergency fund and an emergency happens, it has a financial cost, you have to pay for it somehow. So then do you have room on your credit card? If you do, fine, but then you have interest that you're paying on that. So you not only did you have an emergency that costs for something that you didn't plan, now you have to pay interest on it. What if you don't have any room and then you're like, oh my God, I have to go get a payday loan. I have to go to I was going to say a company. I have to go to one of those.
I don't want to get sued. Don't be mentioning any names here.
And then not only do you have an unplanned emergency, now you're going to have a financial crisis because the interest rates are so high on those payday loans. Once you're sucked into that cycle, unless something magical happens or you file a bankruptcy or a proposal, it's really hard to get out of those payday loans.
Yeah, and I totally agree. You do not want to be using a payday loan as your backup plan. But the counter argument to what you just said is, yeah, okay, that's fine. But I have a credit card. It's got a $10,000 authorized limit. I've only got $1,000 on it. So if I do have an emergency, I've got $9,000 worth of borrowing ability there. So, and in fact, I'll take it one step further and say, I've got a credit card that there's nothing owing on it. It's got zero balance on it. So why not just rely on that rather than trying to scrimp and save and put money into an emergency fund? Because let's face it, I build up an emergency fund. What am I going to do with it? I'm going to put it in the bank so that's accessible and in the event of an emergency, and the bank's going to pay me pretty close to 0% interest because maybe my emergency fund is $1,000 and the bank isn't going to pay me much on $1,000. Whereas if I've got a credit card, well, I would be far better off paying that down. So back to my example, I got a $10,000 limit. I got $1,000 in my credit card. And I just got $1,000 tax refund. Okay, well then Doug Hoyes would say, pay down the credit card, save the interest. Under what circumstances could it possibly make sense to say, no, I'm going to put that $1,000 into an emergency fund? Are there any?
I too am on the fence. I think it's really important to have that emergency fund there because it's all well and good to say, well, I have room on my credit card. I will pay it down. But how many people do we meet on a daily basis that have had that exact same plan and then end up in huge financial stress that they can never get out from underneath unless they have help? So there's a danger in that thinking because then you're like, okay, well, I'll just put this on and I can pay it off. Yeah, but you're paying like 20% interest on it. It's not as easy. Like your money, it's not like you owe 1,000 and you're going to pay 1,000 and you're paid off. That's not how that works.
Now, and we're going to come back to that because I think that's kind of the gist of the argument. But you have been on this podcast many times before, and a lot of the time you talk about the psychological aspect of life. Right. And I don't know if you studied in university or what. I mean, I'm a numbers guy. It's like, it's numbers to me. It's the answer is always the numbers. Well, which is exactly right. So now, but I guess the argument in favor of savings is from a psychological point of view, it's a habit. Tell me about that.
So you do want to create the habit of savings, and it's also it's a confidence thing as well. So I know in the last podcast, we talked about the one study that talked about the 3 groups of people, the ones that had money could save, the ones that didn't have money, didn't know they didn't have money, but they saved. And then there's the people who didn't have money. They knew they didn't have money and they couldn't save because they didn't have the confidence to do so. And I would add in a 4th group, and that's the people who make money, but they don't feel like they can save. Because although they have lots of money and they just don't have that same confidence. And it could be because of their money script. Everyone has a money script in their head. So I think it's important, like you can delve into the money script and figure that all out. There's some great books on that. The one gentleman's name is escaping me. I'll try to remember or we'll post it later. But if you don't want to do all of like that kind of work, then just set up a simple system that puts $20 aside a week or $40 every paycheck, that just shunts it aside, puts it into savings, and then it's just there and you don't think about it. And then that creates the habit of just making sure that, you live your budget less because you live your life less. You reduce your expenses because you've already set it aside. I think that's really important to do because a lot of us could probably shave a couple $100 out of our budget, or off of our income and still live a pretty okay life. Does that? Yeah. So, I mean, it's the habit of getting money aside that's really important.
And I guess that's your point, the habit. So, okay, the previous example I gave maybe was too obvious to have an answer, but let's take a simpler example or maybe a more nuanced example that I have a mortgage on my house or I have a car loan and I'm allowed to make a prepayment once a year. I can prepay $1,000 once a year. So my choice is during the year, do I put that $1,000 into savings or do I use the $1,000 to prepay the car loan? Now, if my car loan is at a 7 or 8% interest rate, obviously from a financial point of view, it makes sense to prepay it. But if I've got a high interest savings account at one of the online banks and I've got the special deal where I'm getting 4 or 5% interest, then maybe the difference is it's a couple of points. I'm saving 2%. What's the difference? Maybe it would be better to establish the habit where every paycheck I'm putting $100 into that high interest savings account. Under that scenario, does it make more sense to favor the emergency savings over paying down debt?
I would still say yes. It's very important to have emergency savings because I think it's really important to at least have something in savings, right? You get to a certain point where you have a threshold. Okay, I've saved $1,000, I've saved $1,500. I have simple emergencies, the ones that are likely to happen. I have those set aside. And then you can start to change your strategy, right? It's not like you set it and then you completely do it. So let's say you did have the habit of putting, $100 aside for a year, right? For savings. And then you're like, okay, now I have $1,200. Okay, I'm good with that. Now I need to focus on debt. Don't stop putting money into savings, but maybe reduce it. Just have like $5, $10 go inside so that you're still used to the habit of having it go, but then switch and focus on paying down the debt. But I still think that having at least a minimal amount for emergency savings is really important before you start to pay down debt.
Yeah. And I guess if you're trying to establish a habit, well, whether I'm putting in $100 or $5, it is still a habit that I'm establishing. So okay, makes sense what you're saying. Get the emergency fund to where you need it to be and then switch your focus to the debt. How much does your emergency fund need to be?
That varies. So there's, I think minimally you want at least $1,000 in there minimally, because usually a vet bill or a tire change or whatnot, that's kind of covering that off. But then you also want to think of, well, what if something bigger happens and I'm off work for 2-3 months and EI doesn't kick in for a month and a half? Like, what happens if something's going to impact me for 2 or 3 months? So then you're looking at having 3 to 6 months of living expenses saved up, with the caveat that if you are employed and you're going to be getting EI or something happened and insurance will be kicking in, or there's a long-term disability, there's some sort of supplement to your income. You don't need to have the full 3 months of living expenses saved. You need the differential saved.
Yeah, I agree. And I guess my answer to that question would be, well, let's think of what the emergency is going to be. So you're right. A flat tire, I don't know, maybe that costs $100 or $500, whatever the number is. A vet bill, well, that could be $200 or it could be $3,000. I guess it all depends. The most likely scenario is I lose my job. Like that would be the most common thing. So if I lose my job, I get laid off tomorrow, what is likely to happen? Well, I guess if my employer goes bankrupt, I'm not getting any severance or termination. If I work for some huge company and they lay me off, they're going to have to pay me some kind of severance or termination. So maybe the emergency fund doesn't need to be as great. How long does it take EI to kick in? I don't know. It depends on the facts. If you get severance or termination, well, then the EI kicks in later. If you get laid off immediately, then I think EI starts kicking in like a couple of weeks. But
once they process it,
yeah. So, and they may back pay you, but yes. Right. So it seems to me that, yeah, under that scenario, I've definitely got to have a month's worth of expenses saved up, because that's what I would likely have to cover. Now, I'd have to pay my rent on the first of the month. I mean, I guess my phone bill, my gas bill, my hydro bill, well, if I pay those a little bit late, it's going to screw up my credit score and maybe have some other implications, but it's not the end of the world. So my answer to that question would be, if my income stopped tomorrow, how much money would I need until I can replace that income? At a minimum, it's probably a month. That's probably the number. Like 3 to 6 months would be great, but that's not realistic in the real world. Like, come on, like that's not a thing. I mean, if you make $3,000 a month at your job, 3,000 times 6 months, I can't even do that in my head. It's such a huge number. Isn't that $18,000? Is that right? You got a calculator there. You tell me if I'm doing it right. Yeah. Nobody can save $18,000. Like that, right. That's just crazy. And for us to sit here and say, well, you should have 18,000. I mean, that's just silly. So do you agree that a month is your first target? Or do you think I'm underestimating?
No, that makes sense. Because even if you add it up, if you calculate out the differential, it would probably just add up to 1 month, right? So yes, that would be a good target.
And
doable.
Okay. And not tomorrow, but over a period of time.
And not the extravagant budget, the basic budget. Rent. What do I need for rent, utilities, food, standard payments if you have a car payment, but not eating out, not those things, right?
Yeah. And even something like a car payment. Okay, I guess if I lost my job, I could probably phone the lender and say, hey, can I defer a payment? Probably do the same with your mortgage. Maybe you got to pay for it. Obviously, the interest goes up. But okay, so we've got to be realistic about it. And I want to get back to the central question about whether I should be paying off debt first. But my next question is, okay, so let's say we all agree that the target is I want to save up 1 month. That's my target. And let's say that number is 1,000 or 2,000 or 3,000 or whatever the number is. Where should you put that money? Should I be putting it in a savings account under my mattress? Should I keep it in cash? What should I be doing with that money?
Some of that actually has to do with who you are as a person. I've met people who are like, if I have cash, I don't spend it. So great. If you want that as cash, but then make sure you have a fireproof safety, like a safe, so that your cash at home is secure. If if anything else should happen, at least the money's still there because you don't want it to disappear. So anyways, so make sure that's protected. If you're doing it, obviously more in the digital world, you're putting it into the bank account. I would say a savings account, at least to start with, right? It's easy to have the money get set into a savings account. You can do the high interest savings account and then when you get to a certain limit, you might want to switch it over and put it into a TFSA, right? But you always want to make sure it's fairly readily available, and you're not going to be penalized for taking it out. Like you don't want to lock it in because it's an emergency fund. You don't know when it's going to happen, so it has to be readily available. So TFSA, I think you get it into your bank account like within a day.
Right. You're not going to put it in a 5-year GIC.
Right. No. Exactly.
Now, you didn't mention crypto, I understand. So which crypto would you recommend? Like, are you Bitcoin only, or should I go with one of the really risky ones? Like, what do you think for my emergency saving fund? Which crypto would you recommend?
Yeah, considering I only know about Bitcoin, I think, no, I would not put it in crypto.
And I guess the reason not is volatility. Like the whole point is that, Bitcoin, which is like the biggest one, and I guess kind of the most stable one, can have a 70% drawdown in a year. So that's sort of it could go up by 500% tomorrow too. But okay, so not
there's
a big
other things that people are like, well, I'll put it into an oil company, or I'll put it into like some sort of, company that's been around for 30, 40 years. They've been super stable. I would still not put it into any kind of an investment where there is a potential of any market volatility, because you don't know when the world will kind of do something crazy and then things collapse. So you want to make sure the money that you're putting in is the money that you're going to be getting out.
Now, how far are you where you're sitting right now from the old Nortel headquarters?
Oh, I think 10 minutes.
Yeah, not far. And
no, not far.
Nortel was the biggest company on the Toronto Stock Exchange by a wide margin. Everybody was in it, and it doesn't exist anymore. So I think even if a company's been around for a long time, it can disappear pretty quickly. So I agree with you. Emergency savings has to be something accessible, because the whole point is it's an emergency. I need to get at it. My vote would be, if it's a relatively small amount, I've saved up $100, $200, $300, great. Put it in your savings account. I think once you get to a bigger number, then a TFSA would be my choice, because the TFSA is hidden. It's not on your debit card. You can't go to the store and accidentally spend your TFSA. You have to actually, you can't spend anything from your TFSA. You have to transfer it from your TFSA to your savings or your checking account. And you're right, you can do that online. It doesn't take any time at all. So I think it's great as an emergency fund, but it's also out of sight, out of mind. Now you still see it on your banking app. I get it. You still know it's there. But
I put mine in a separate bank. So I have the bank that I bank with and I see regularly. And then my other stuff is at a different bank, so I don't see it. Like I have to specifically go in and look. That way, because sometimes you can convince yourself, you're like, oh, well, yeah, the kids really do need a new pair of shoes, and that money's sitting there and I can rebuild it, right? Once you're kind of talking to yourself that you can do those kinds of things, you need to stop and just go, no, that's for emergencies only. I cannot touch it. Needing a new pair of shoes, not an emergency. Right? Well, I mean, unless
it might be. I mean, I guess if I lost my pair of shoes,
the way my kids, there's no sole on this shoe, and I have no other shoes.
So you got to get a pair of shoes. So my only caveat to that, so my vote is, well, if you can have it in a TFSA, that's better. Obviously, if you're using a TFSA like a savings account and putting it in, taking it out, putting it in, taking it out, you can eventually hit your limit because there's a limit to how much you can put in. So now the limit will reset next year. So it's not like an RSP where you lose the limit forever. And I definitely would not be putting my emergency savings in an RRSP because yes, you get the tax break when you put it in, but then when you take it out, you're paying tax. So the emergency fund is not as big as you think. So I think if you've got lots of TFSA room, then TFSA would be my vote. But if you've got, if you've already maxed out your TFSA, well, then maybe it's less applicable for you. So okay.
And realistically, sorry.
No, go ahead.
If you have money in a TFSA, you shouldn't be in and out of it all the time.
Right.
Like it's meant to be kind of set aside. That's probably one of the elements that's nice about the TFSA is that limit of transit, like the money limits.
Yep.
So you're discouraged from going in and out of it. So if you're, so again, like standard emergency savings is one account. Normal operational savings for things coming up during the year is a separate account. Like clothing, gifts, all of that is in a different savings account. You're in and out of that all the time.
Yep.
Emergency savings, you're not. Unless there's an emergency, you're not touching it. And I did want to make one point. If you have a debit card and your savings is attached to it, like you tap and you can choose, you can go to the bank and just say, remove the savings from my debit card so that you never see it.
And that's a good idea because I'm probably not spending my savings on a daily basis. So
sometimes it's accidental. Like you kind of click and you're like, oh crap. Yeah.
Well, and I don't actually know how to tap, so I don't have that problem. I have to punch the thing and punch the thing and punch the thing. But yeah, and I guess we're having kind of a theoretical discussion here because if you've got $50,000 in your TFSA, you probably don't need to worry about an emergency fund because you got money there anyways. Okay, even if it is in stocks and bonds and whatever, you cash one of them in, there's no tax implications, whatever. So we're talking about the beginning of the process. So to review, why you should have an emergency fund and build the emergency fund before paying off debt, you said, well, you get into the savings habit, which is something you want to do for the rest of your life. It also gives you confidence, was the word you used, that, okay, I know I can do it. I've got money there for the future. The second reason is if I pay down my debt, then I'm taking a bit of a risk because the lender may end up canceling it. They may say, oh, you got this line of credit for $50,000, but you never use it. So we're just going to cancel it and you don't have a line of credit anymore. Or they could reduce your authorized limit. Okay, your credit card, instead of being $20,000, now it's only $5,000. So you don't actually have access to it in the future. And then I guess the other point you had made that, well, if you're paying down debt and then you use the debt to function, you're not really paying down debt. You're just, trading dollars. So those all make sense to me. Now, my counter argument to all of that, why you should pay off debt, and you already mentioned this, the obvious answer is interest. If you're paying interest on your debt, and that's how debt works. I don't know of any debt that has zero interest. I mean, I don't know, maybe you got a car loan 5 years ago where it was zero interest, but in the vast majority of cases, you're paying interest. And I am of the view that the higher the interest rate, the more important it is to be paying it down. So if you have a payday loan, then absolutely pay that off. Don't be putting money in an emergency fund because you're paying 390% interest. And if you got a high interest credit card at 29%, again, seems to me a no-brainer to be paying that off first. Do you agree or disagree with that? And my question very specifically is, if we're talking about really high interest debt, should that not be the priority over an emergency fund?
Yeah, that's a tough one because I still like to have the $1,000 set aside because then it makes it easier. Pay the minimums, get the 1,000, and then aggressively attack the 29% interest rate. The other thing you can do with a high interest rate credit card is just say, you know what, bank, I can't afford this. Can you convert this to a loan? It hurts your credit score a bit, but you can reduce the interest rate at least, but you lose the credit card. But that's not a problem. You can reestablish later on. But yeah, it is really important to get high interest loans paid down.
Yeah. And mean, I disagree. I think if you got a wickedly high interest rate loan, pay that down. I mean, we're talking after-tax dollars. You don't get a tax deduction for what you're paying on a payday loan. So I'm hardcore on that. But I do understand the other side of it. It's a much more difficult question if you're talking about a 7% interest car loan versus I could earn 5% in savings. Okay, well then I guess I'm much more indifferent. But if you've got a high interest credit card, then I think that's something you absolutely want to attack. Now, you raised an interesting point there. You mentioned the word credit score. Right. So if you pay down debt, you are going to increase your utilization. Sorry, you're going to reduce your utilization, and that will, all else being equal, improve your credit score. So is it not a good idea to improve your credit score?
I think it's important to be financially stable. That's a more important goal than it is to have a great credit score. Like a credit score is a risk assessment. But really, if you have financial stability, you will care far less about your credit score.
Yeah. So what you're saying is if you've got money in your emergency fund, you've got some financial stability. So I guess I'm less worried about my credit score. I guess I'm saying, well, everybody I meet is obsessed with their credit score because that's the most important thing in life. I know. I try to encourage people not to check it every 5 minutes, but I get it. That's kind of how we've been taught to be wired.
Well, and sometimes it's impactful. Like if I'm going to have my mortgage renew and I have a lower credit score, or I want a good interest rate on my car loan, I need to have a good credit score. So, I mean, there are reasons why we want it, and we both recognize that. But we just want to we can't make the credit score the only reason why we make a decision. The decision has to be best for your overall financial health.
Yeah, I agree with that. And I guess maybe that's part of the answer to the question. Well, if my mortgage is coming up for renewal in 6 months, or I'm buying a new house, or I'm financing a car or something, okay, maybe over the next 3 or 4 months, I do want as high a credit score as possible. So maybe what I do is I focus on getting that debt level down, because that way my utilization also drops, increases my credit score. Once I've then refinanced the car, the house, whatever it is I'm doing, okay, now I can maybe switch back to focusing more on the emergency fund. So there is no one answer for everybody. You got to look at your individual situation. My final point on why you should pay off debt first, interest being the obvious one, but my final point would be, well, if you do pay down that debt, then you still probably have access to it in the event of an emergency. So I pay down my credit card, I'm not paying any interest, but if the car does break down, I can use my credit card. That makes sense to me. Do you agree?
Yeah, I do. You can pay down your credit card. You do have access to it. It's just, really focus on building up the emergency fund so that the credit card isn't your go-to.
I agree. You don't want the credit card to be the go-to. And I guess it's very tempting if I have a paid off credit card to go, I think we're going on a vacation this summer, to a farther place than I thought we were going to go, and we can spend a little money. So it gives you the illusion of wealth when it is not really there.
Exactly. So write debt on your credit card.
I agree. It's a debt card, not a credit card.
Debt card. And there is many people I have spoken to. They're like, I'm still paying for that vacation I had last year. Yeah. It doesn't feel so good anymore. So it's better to save for the vacation. And then people are like, well, wait, how can I even live? I'm saving for an emergency. I'm paying down debt. Will I ever go on vacation?
Yeah, and the answer might be, well, maybe this year it's going to be a staycation. It's something close to home. It's not going to be a big thing, but maybe next winter or next summer, okay, I've got more time to save and I can build up to it. And I guess the other problem with paying down debt is if you pay it down, as I said earlier, the bank may say, oh, well, we don't think you need that big a limit anymore. So now I've paid it down, but I don't have access to it in the future. That's a bit of a risk. But anyways.
It's good to have your limit reduced.
Well, yeah. Like if you don't need it, then you don't need it. So maybe it affects utilization and some other things, but it's not necessarily all bad. So, okay. So what is your final comment then? How do you wrap it all up? Emergency fund versus debt. Which should I prioritize? I guess you're saying you do prioritize having at least something in an emergency fund.
Yeah. And realistically too, like if there is a high interest debt that you want to aggressively pay down and you're using your income to do so, then when you get found money or unplanned money or money we forget about, like the GST or like Trillium, anything extra, toss that into the emergency fund. Right? So then that still gets built a little bit while you're aggressively paying down the high interest.
Yep, that all makes sense. And I guess my final comment on all that would be whatever it is you're doing, have a plan. So I think we've sketched out why you should prioritize an emergency fund or why you should prioritize debt. Everybody's situation is different. If you got a lot of high interest rate debt, then I think I'd be prioritizing that. If it's not so high, okay, maybe the emergency fund is psychologically better, gets you into the habit and so on. So I think you can make that decision. But the point is you should actually think about what the decision is. Have some kind of plan. Here's where I'm trying to go, and then make the decision based on that. So there you go. I got the last word because that's just the horrible kind of person I am. Maureen, thanks very much for being here today.
Thanks for having me.
There you go. That was Maureen Parent, 10 minutes away from the Nortel head offices that I assume no longer exists in near the nation's capital. So,
well, I think D&D's there now.
Okay, so there you go. The government has replaced them. So it's everybody wins then, I guess. That could be another show. So, for those who are watching, thank you very much. If you're on YouTube, you know how to do it. Click the buttons, all the notifications and whatnot. We have a new podcast every week. Feel free to leave a comment below as to why I'm wrong and you should be doing it differently than what I'm saying. I'm sure you'll all agree with Maureen, but that's fine. Put your comments below. If you're listening on the audio platform, which is how most people listen to us, Spotify, Apple Podcasts, whatever, again, subscribe, leave a comment, leave a rating. It helps the show out. And we will have another show next week. So that is our show for today. Thanks for watching and listening. I'm Doug Hoyes. That was Debt Free in 30. 31. That's pretty good. We got pretty much there. So, okay, beautiful. Let me stop all of the different recordings.